Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 1st, 2012. And tonight I'd like to talk a little bit about the VIX. This is actually a chart, or at least these annotations on this chart that I'm going to talk about tonight I had actually put up a couple times, and it's been a while. It's been a few weeks since I put this up, but a few things I wanted to point out. And later on this evening or possibly tomorrow I might put up a second segment, an audio or a video segment like this that talks about trends, where we're at as far as primary downtrends, intermediate term, short term, and all that. Obviously the short term trend is up, but I do want to point out a few things about the longer term trends and how I help formulate my current market bias, which I do want to expand on that a little bit before I get going here on the video. Obviously, I've been making a pretty good case that we're at a possible inflection point here. How the market could turn down, very similar to what we did in 2008. How far we go from there, it's hard to say. Do we turn down at all? I can't say that either. All I can say is that from looking at these charts, with as much of an unbiased take as I can, I do point out a lot of similarities to the recent, well, not so recent, the pushback up in 2008, coming off our highs. Again, we peaked out in October of 2007, and we had that first, what the Elliott waivers will term the wave one down, and then we had a nice strong retracement that looked pretty convincing, and that was our wave two up, and that peaked in May of 2008. And those are a lot of the comparisons that I and of course some others are making to this market at this point in time. Are things exactly the same? No, of course not. They never are. But that leads me into this discussion about the VIX, because again, I think there are a lot of similarities worth noting. And whether they play out the same way or not, only time will tell. But there's an old saying out there that I like to use, and that is, those who ignore history are doomed to repeat it. So let's talk a little bit about history here on the VIX, and compare it to how things were back a few years ago. Alrighty, let's start with this chart that we're looking at here is a VIX weekly time frame. Going back, quite a bit, 2003. In fact, I can zoom up a little bit here. Let's do that and take a look. Okay. Now, what I'm going to do is superimpose the S&P 500. So we're going to go here to comparisons, take a look at the S&P 500, and then I'll explain these vertical lines that I have on the chart. All right. The peak, as I mentioned back in October of 2007, was right here in the market. So what I did is I put a vertical line showing where the VIX was at that time. Now the point I'm trying to impress today is that market tops, whether we're at one or not, that's of course going to be yet to seen, but market tops always come at a point of complacency, an extreme bullishness, as we had back in 2007, and we had, of course, again back at the push up here in 2008, May of '08, just before, at the end of the wave 2 up push, just before the big wave 3 down, and then I'll compare that to where we're at here today. But let's take a look at this line. As you can see, I lined it up with the peak, and hard to see the candlestick, especially when I move my mouse over these. They sort of blur out a bit, but that's the VIX fell to about this white line right here, and that was of course the market top. Then on the wave 2 up, which peaked out in May of 2008, as you can see, the VIX came down to virtually exactly that same level there. So this is this line I'm going to talk about tonight, and some other similarities as well. Okay, let's look back here real quick. That was when we peaked out. We were coming off, one of the most powerful bull markets in a long time. And as you can see, this is what a top looks like. VIX gets very low, bullishness is running high. It looks like things are going to go on forever. There's calls of Dow 20,000, 30,000. You hear it all out there towards the top. Of course, housing prices were just going to keep going up forever. et cetera, et cetera, et cetera. But either way, just take a look at what a top looks like on the VIX, and this on a much smaller scale sort of reminds me of that, sort of a rounded bottom here, like we had leading up to the top at this point in time. And then you get an initial couple little early shock waves or shot across the bow, if you'd like to call it that, where there's some fear and market starts to get toppy, and then as I show here, we had a pretty sharp drop off in the VIX, and then boom, there's the first move down. You get a couple spikes here, and what you'll see, I noticed, or what I labeled these peaks number 1 and 2. I do remember, and you can reference this on a chart going back, that initial wave down on the 2007 to 2009 bear market. We had nice positive divergence on the MACD. We put in a lower low on prices here. There was a spike down here, then a subsequent low on the MACD. We had positive divergence, just as we did on the recent lows here that bottomed out in October. Virtually identical structure, posture on the MACD. I covered that in my recent couple market updates that I did. And as you can see, the VIX also registered a lower low. So we had, even though prices in the market had gone down to a lower low, the fear factor, the VIX, actually put in a lower low instead of, you would normally expect the VIX to be even higher on this low. But that just shows that there was a little more complacency, less fear built into the market, at least by this measure. And then the push up, and of course the VIX just dropped off and fell back down to really where it was at the peak of the market back in December of 2007. So that's what it looked like back then, and we all know what happened after that. The rest is history. And let's take a look at where we are today. Of course, this white line again is the S&P 500, and as you can see, this line here is the top. I marked the top, which was back May 3rd, 2011, and then we had that initial drop off, and of course, just like back here, we had a surge up in the VIX. And although it's very hard to see here, for some reason the candlesticks are overlaying my S&P prices, but we had a lower low put in on the S&P as well. And just like back here at this point, we had the second reaction high on that lower low in the stock market. We actually had a lower spike on the VIX. So I labeled those number 1 and 2. Only because they're very similar in both time. If you look at the distance here, the scaling is about within, if I'm not mistaken, within days or a week or a couple weeks there. And then after that second spike, we began this strong rally, and of course the VIX has just dropped off. Yes, it's had it's spiked a little higher this time around, and that's probably largely in part due to the fact that we are coming off of a vicious bear market that's still fresh in everybody's memory. And that's also, in my opinion, why this market's been so resilient. Every time we see any type of pullback, the put-call ratio shoots through the roof, short interest spikes, and on top of it being a low volume market as is, when you have a high short interest, then you get a high short interest ratio, which is the days to cover. If you're not familiar with that, take a look at that term, but it just pretty much says if a large percentage of the shares out there are short at any one time, that's going to really help put a floor in stocks, because it leads to short squeezes, and pretty much you have a lot of bears in the stock already. Not many more able to pile in there. So, okay, let's take a look and see this number 3 here. Again, I used this horizontal line because that's where we had fallen to at that point back, early stages of the last bear market. And this is what I wanted to point out. During a bull market, it's normal, a strong bull market, for prices on the VIX to come down and remain down. And this is why I wanted to point out this, what I referred to as a similar topping pattern, because yes, prices did hit that line and stayed down here for a while. But let's look at it this way. Since the last bear market began, if every time the VIX had come down and hit this level, which is around the $16 mark or so, had you taken protective measures and sold your longs or shorted the market or bought some VIX calls, you would have in very short order made some pretty nice gains. As you can see here, every time the VIX hit that level, we got a sharp reaction off it. Prices on stocks fell. Happened again here. I mean, we're talking one candlestick tag, and then look at that move. It's pretty substantial, from 16-ish all the way up to 30. That's nearly a doubling in the VIX. And of course, then the sharp move up happened again here. It took a couple years, for the VIX to fall back at that level. There was a lot of fear built into this market after that vicious bear market. But after a while, the VIX did return to that level. And as you can see there, it didn't stay here very long. It shot up, and not only did it move off that level, it had a super sharp spike. We're again going from 16 to about 50 in very short order. And then we fell down, and that's where it started to bottom. But if you really analyze this, and remember all these are weekly candlesticks, you'll see that usually when it hits there, you get at least some bounce, and even a move from 16 to the 20 area in short order is a pretty good move in the VIX, and that usually leads to these pullbacks that you see here. So I'll let you analyze each little tag. But of course, this just built complacency. The VIX stayed low for a while. And when complacency sets in, this is what happens. And again, I'm using the example that, in this scenario that I'm talking about, if this is indeed a top being put in here now, or was a top back in May of 2011, as I still maintain, this was the topping process, as was over here. And therefore, after the market topped, the first several tags of that level led to sharp reactions. So now here we are today. We're not at that level yet. There's a little bit of downside, although the NASDAQ VIX, the VXN, is actually at that level. Just something to point out. But here we are on the S&P, very close. Yes, is there some downside room? Absolutely. But is it possible it doesn't get there? We've gotten close enough? I don't know. So that's why I have the question mark here. Maybe this blue line, which I'm waiting to move over, if we do get a reaction off that level, I will be dragging this line. That it's possible that we look back now and say, well, this was the time to go long the VIX and get out of stocks, or maybe we have another push up, takes a few more weeks, and we get down here. It's possible. Does it plummet through that line and keep going down as the market goes up? Absolutely. But again, trading is all about probabilities, recognizing patterns in the stock market and past prices, and then acting accordingly. And again, am I telling everybody to go out with short the market with both hands? No, absolutely not. Aggressive traders, as I mentioned, may want to start scaling into some shorts here in anticipation of a turn or a sharp pullback. Again, that seems to be the history with the VIX hitting this level. I know trend traders will trade a trend until the trend's over, and that's sometimes easier said than done, because there's a fine line determining at what point is the market just having a pullback, which you hold and ride through, or was that actually a top? And you're going to wait till the market's down 10, 15%, 20% before you decide, hey, this wasn't just a pullback. I've been adding to my longs all along, and now I'm really underwater and gave back profits for the last few months. Because one of the problems with the stock market is it tends to drop a lot faster than it goes up. That's usually what we see for the most part. So either way, I wanted to point these similarities out, and again, is it an all-out short signal at this point? Absolutely not. We haven't yet seen that reaction off this level, but it's something to be on the lookout for. And I believe last week we had a couple of buy signals on the VIX. We haven't seen a lot of solid follow-through. In fact, the VIX was down about 4.5% today, but something to look out for. Now let's real quickly take a look at the VXN, the NASDAQ Volatility Index. And again, I've superimposed the the NASDAQ here. Let's see, I must have moved that line. There we go. This was the top on the NASDAQ, which back in 2007. As you can see, there's a red candlestick. This video is in high definition, and if you haven't done so already, you should go on the YouTube down to the bottom right-hand corner and click that little wheel that looks like a machine cog wheel, whatever it is, for settings. Select high definition, or the highest quality you can choose on your PC, and you should be able to maximize this to full screen size and see everything pretty clearly. So if you do, you might be able to pick up that red candle that hit that line. And again, I did the same thing. These lines mark the trough of the first wave down here, and you can see, of course, just like in the S&P, we had a lower spike on the VIX as the markets made a lower low, so a little less fear. Markets pushed back up to their wave 2 high, and of course the VIX fell right back down to about where it did at its peak. And again, the rest is history. Here's how it looked this time around. Market top was right here in 2011. We had a lower low on the VIX, but a similar rounded bottom formation, which again, I'm viewing this as marking, what a typical market top looks like, similar to what we did here. This was, of course, a larger, much larger uptrend. This bull market was a larger uptrend, hence a larger topping pattern in the VIX than this one, but similar patterns. And again, you can see the similarities. First move down. We have this sharp downtrend line right now, and the prices on the VXN pretty clearly defined, and typically the sharper the downtrend line is, the sharper the reaction is on the break on the upside when it finally does break out. So there's where we are today, and as you can see, prices on the VXN have come down to that level where they had fallen back before, and it works as a pretty decent, not the best support level, but even when you go back through time, you'll see quite a few reactions off that line at various levels. So that's what I wanted to point out today. Okay, folks, before we wrap up here, I just wanted to touch on the 2-day VIX here as well. The daily, this is a 2-day chart, like a daily chart, but using every candlestick represents 2 days action. And this is that line, the level that I'm looking at here, at least how I have it marked on the daily chart. It might be off a little higher or lower than I have it on the weekly, but this is set up really to pick up, the most reactions off this level on this period. And as you can see, the VIX typically works in these bullish falling wedge type patterns, and not always as clear as some stocks because we have a lot of volatility with the VIX. So sometimes we'll have these little temporary breakouts, but this is how I like to draw trend lines, and sometimes I'll exclude the occasional overshoot if there are a lot of points that line up. So either way, these are my falling wedges, and here, false breakout, then the real deal came back to back test both this falling wedge and that key support line, which goes back, to at least to the last bear market. And as you can see, the reactions off that line, these are only a few days here. Each candlestick is a 3-day period, so usually within a week or so, sometimes less, you get a sharp reaction, or at least we have in the past. Again, another bullish falling wedge back to support. This was that topping process that I talked about for the market highs back in May. Here's May right here, May 2011. And of course, fear, or at least as measured by the VIX, was at its lowest point in years, at what is still to this day the market top. And what I'll notice too, or what I'll point out, is these wedges are getting smaller, especially this one, much smaller, steeper, and therefore I would expect that when it does break, you're going to see a pretty sharp move up as well. Typically, the less the slope of a wedge. From my experience, the breakouts, are more sustainable, happen over a longer period of time, and these sharp wedges usually lead to pretty sharp moves up. So, are we going to touch this level again? possibly. If we get down there, I'll probably be a buyer of VIX calls. We'll see. I might even start scaling into some at this point in time, because as Mr. Market very often likes to do to us all, if we're watching a key level for an entry or an exit on a stock, a lot of times other traders are watching that level too, and it may never get there. That's why personally on a lot of my stocks, if I list a target at let's say $15, I might have my sell order, just a few pennies or nickels below that level, just to make sure I get a fill. So there it is, folks, and as I said, I'll probably work on another video about making a case for what the primary, intermediate, and long-term trends are in the market, and look for that in the next day or two here. This has been Randy Finney with Right Side of the Chart, and thank you for watching.